Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. And straight ahead on the program, a look at how some recent box office blockbusters may have impacted quarterly results at the world's biggest entertainment company, Walt Disney.
I'm Stephen Carroll in London, where we're asking if Rachel Reeves can sell the British dream in America.
I'm Brian Curtis in Hong Kong, along with Doug Krisner in New York. We look ahead to Alibaba's earnings, and we preview China's upcoming trade data.
That's all straight ahead on Bloomberg Daybreak Weekend on Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 106.1 Boston, Bloomberg 960 San Francisco, DAB Digital Radio London, Sirius XM 119, and around the world on BloombergRadio.com and via the Bloomberg Business app.
Good day to you. I'm Tom Busby. We begin today's program with the Walt Disney Company set to report third quarter earnings on Wednesday. The world's most popular parks, cruises, movies, broadcast, cable, streaming properties, the list goes on. For more on what to expect and what investors are looking to hear, we're joined by Thomas Buckley, Bloomberg entertainment reporter. Thomas, thank you for being here. Why don't we start with what you're expecting to see in these results?
Great to be here, Tom. It's going to be a really interesting set of results for Disney, especially, as you said, one of the world's most popular parks companies. I think that what's going to be very interesting for shareholders here is to gauge the performance of the parks in the current period. Basically, we've seen Comcast report earlier in July results that were fairly tepid in its parks division, so that includes Universal Studios. And Disney had been very clear early on that they have seen demand start to moderate at the parks following a peak as we came out of COVID. So that's been well flagged, but we want to see exactly just how much the slowdown has impacted the company. CFO Hugh Johnston was very clear last quarter that the third quarter would be impacted by costs related to its cruise division as well as higher inflation. So that's it on the experiences side. What's interesting as well on the entertainment side is to see whether or not Disney is going to be able to achieve its first profit since April 2022, thanks to the blowout performance of the blockbuster Inside Out 2, which is a Pixar film.
And they've got Deadpool and Wolverine, which just came out, won't affect these earnings. And in the pipeline, some huge movies, Moana 2 in November, Mufasa, The Lion King at Christmas time. Parks always seems to be driving earnings, but is this division really hitting it out of the park right now?
That's a really interesting question. It certainly feels as though this is the year that Disney's movie studio has truly come back to past performance. There were a few stumbles in recent years. If we think about last year's Ant-Man and the Wasp: Quantumania that called into question the appeal of the Marvel franchise, that was then followed by The Marvels in November, which also did not perform well at all. If we think about the film Lightyear back in 2022 that called into question the appeal of the Pixar franchise, both of those franchises seem to have really come back this year, with Inside Out 2 in June for Pixar, as I mentioned, and then Deadpool and Wolverine. The numbers on this are absolutely outstanding. It's the highest ever R-rated debut in terms of an opening weekend in history. It's already grossed above $500 million and could easily compete with Disney's own Inside Out 2 to be one of the biggest films of the year.
Yeah, a little confusing to people, though. Moana is a 2. Mufasa is, I think, the 3rd in the series. Deadpool and Wolverine, the 3rd in that series. Not a whole lot original coming out of that studio, though.
That is certainly true as pertains to this year. I think that what's been interesting ever since Bob Iger came back as CEO in November 2022 is his ambition to get the studio back to past form. And the way that he's done that is he's pulled back on some titles to focus exclusively on their quality to make sure they're as perfect as can be at the time that they're released. And coincidentally, what's happened is that the primary focus of films this year has been on sequels or spin-offs. And so far, that's worked out very well for the company. I think it serves to remind audiences what they once loved about these franchises. And we can certainly expect a lot of originality coming down the pipe next year.
Now, another big part of Iger's turnaround is the focus on streaming, and it just locked down an 11-year deal with the NBA along with some partners, Comcast and Amazon. But streaming, what do investors hope to hear about the streaming numbers? And it has a lot of properties. Hulu is part of that family, ESPN with a standalone streaming service, of course, Disney Plus. What are we looking to hear in subscribers, and what's ahead for the streaming division?
Absolutely. So a view that's very well documented at this point on Wall Street is that for the longest time, shareholders were purely focused on subscriber growth. And especially at the peaks of the pandemic, when the market cap of Netflix was what it was, with people locked at home, I think that that focus has now since shifted to streaming profitability. And Disney has lost in excess of $11 billion ever since debuting the flagship Disney Plus streaming service in 2019. And now I think that shareholders are becoming increasingly impatient and want to see profitability in the streaming division. Now, Disney has been clear that achieving profitability would not be a linear exercise. There would be ebbs and flows quarter to quarter. Last quarter, they came very, very close to achieving an overall profit in the streaming division. So for the third quarter, CFO Hugh Johnson had flagged that he doesn't expect growth in core Disney Plus numbers of subscribers. As a result, we're probably going to see the overall division come down slightly lower than achieving a profit. We're thinking maybe $100 million in losses in that division this quarter or thereabouts. Now, Bob Iger has said that he's very confident in achieving streaming profitability by the end of Disney's fiscal year, which would be as early as next quarter.
Now, investors are going to be a little restless to hear those kind of figures, those kinds of losses, and maybe muted subscriber growth with all the competition. Do you think people are not going to be happy?
I think fundamentally Disney has flagged repeatedly that achieving a profit, as I mentioned, in streaming would not be a linear exercise. And also I think that they have guided towards achieving break even by the end of their fiscal year. So on that basis, I think that, if they hold to that timeline, then the performance will be unsurprising and a relief for many shareholders as and when that streaming profit comes in.
Disney earnings out this Wednesday. That's ahead of Wall Street's opening bell, and our thanks to Thomas Buckley, Bloomberg entertainment reporter. Well, we move next to the ride-sharing companies Uber and Lyft. Uber reporting its latest quarterly results on Tuesday, Lyft on Wednesday. And for more on what to expect, we're joined by Mandeep Singh, Bloomberg Intelligence senior tech industry analyst. Mandeep, the COVID-19 lockdowns are over. People hailing rides again, ordering food deliveries in big numbers. What are you expecting to see?
Well, so I think what we have seen with Uber specifically is the ride-sharing segment has come back very strongly since the reopenings, and travel continues to be strong. So mobility segment, which is their big driver of profitability, should have another quarter of 20% plus bookings growth. And I think in terms of scale, I find Uber to be the best position when it comes to the ride-sharing side. The delivery side is still not profitable. They've been layering ads. They've been pulling back from markets that are not profitable. But in the end, we haven't seen the type of synergy that everyone feels should come with a company like Uber, given its own ride-sharing and food delivery and freight, which is a completely different segment, a money-losing segment. So in the case of Uber, everyone wants to see mobility do well because that's when they beat on their profitability metrics. And look, there has been news about Tesla launching robotaxis, Waymo actually scaling up their robotaxis that they currently have in 3 cities in the US. And that's the big risk when it comes to long-term, what happens to the business model of ride-sharing companies.
How about Lyft, which does not have the food delivery?
Yeah, I mean, look, this is a scale business. And if you don't have scale, then, there is a very little chance of sustaining profitability. And that's been Lyft's biggest problem because, look, Uber with a revenue run rate of over $40 billion a year can barely be profitable because of its mobility segment. Lyft is like 5 times smaller. And that's where, and just like you said, Lyft doesn't have delivery. So that's where it gets challenging to get supply, to really do this in a profitable fashion. There are insurance costs. And look, this is not a software type 80% gross margin business. Ride sharing, delivery, this is more of a 50% gross margin business. And you've got a lot of variable costs. And on top of that, you have a technology threat. If there are robotaxis, then you don't need a human driver or a human courier to deliver. So that's the big overhang when it comes to these two companies. The good thing is the market has rationalized. It's just two players in the U.S. A lot of the other players outside the U.S. are retrenching. They're pulling back, from unprofitable markets. So that rationalization is all good. But if Waymo comes up with a driverless car that can operate in certain zip codes, that really puts a lot of pressure on the take rates for these companies. And that's why you see an Uber stock reacting every time there is news of Tesla talking about robotaxis, even though it was a delay this time around, which is a good thing.
And that's all that Cruise and Waymo are doing right now.
Yeah, I mean, Cruise, I think, has pulled back. So it's really Tesla and Waymo right now who are really pulling ahead when it comes to scaling this technology. There are challenges. I don't think they feel comfortable. These autonomous driving kind of can take care of all the edge use cases. So there is that risk that, you can only operate with certain guardrails and, making sure you don't run into the edge scenarios. But still, as I said, for Uber and Lyft, it's all about the take rates. Yeah. If your take rates compress, then it's going to put a lot of pressure on your business model. And that's why, every time you hear about Prop 22, New York cab drivers asking for more, that is all putting pressure on Uber that, they cannot even talk about raising their take rates. They just have to find a way to be profitable by keeping their take rates low.
Well, let's dive a little deeper into that. The Prop 22 is a victory of sorts in California. Officials there leaving intact, at least for now, the classification that drivers are independent contractors, not employees. And in New York City, officials backing away from their threat to impose a minimum pay regulation on Uber and Lyft and other drivers as long as they stop locking out drivers to avoid paying overtime. So, boy, it's very contentious.
It is, and that's where, if you hear Uber kind of profits jumping 40, 50%, then it brings so much more attention to these companies because on one hand, they are increasing their profitability. On the other hand, the drivers feel they're not compensated very well by these companies.
And marginalized by these companies.
Exactly. And so that's the push and pull that you cannot show too much profitability because then it brings in too much attention to your business and, the fact that you're not paying enough to your drivers. And I think that's not going away, which is why this business is so hard. I still feel, compared to other tech business models, this is the hardest business model to keep showing, steady profitability.
Wow. Well, Uber's latest earnings out on Tuesday, Lyft on Wednesday, and our thanks to Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst. All right, coming up on Bloomberg Daybreak Weekend, we'll discuss whether new UK Chancellor Rachel Reeves can sell the British dream in America. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in our program, a look ahead to some key trade data in China and earnings from the Chinese tech giant Alibaba. But first, the UK's new Chancellor of the Exchequer, Rachel Reeves, has already made her mark, auditing UK public spending, finding a nearly £22 billion spending hole of unfunded and undisclosed commitments. And now she's looking to rein in spending and jumpstart international investment in the UK. And to help make that happen, she heads to the U.S. this week to woo deep-pocketed Wall Street executives. For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Stephen Carroll.
Tom, it's been a busy few weeks for Rachel Reeves, now in charge of the UK Treasury. The dire state of the public finances means she's already had to make difficult decisions to cut spending on things like winter fuel payments for some pensioners and several infrastructure projects. Next up, though, she's jetting off to the United States to drum up interest from global investors in her new National Wealth Fund. The government's plan is to use the equivalent of around $9 billion of public money to get 3 times as much investment from the private sector. Building backing from financial stakeholders at home and abroad is something the Chancellor discussed with Bloomberg in her first major broadcast interview in the role last month.
We've introduced to Parliament today the Budget Responsibility Bill that was first announced in the King's Speech just yesterday. And the purpose of this bill is to provide the fiscal lock so that never again can a Prime Minister or a Chancellor do what Liz Truss and Kwasi Kwarteng did with their disastrous mini-budget just under 2 years ago. So this will mean that the Office of Budget Responsibility, the independent office, can always provide a forecast when there are significant and permanent tax and spending changes, specifically worth more than 1% of GDP. That would have meant it would have triggered an OBR forecast back when Liz Truss and Kwasi Kwarteng introduced that disastrous mini-budget.
And so that, I guess, is something that investors will, take solace to. You've announced a lot. The Prime Minister said that you will achieve that 2.5% target. Are you confident that's achievable?
So the purpose of today really was to give businesses, give investors that confidence that Britain is a stable place to invest and do business. I'm determined to do that. We were elected 2 weeks ago on a mandate to grow our economy based on that stability that is so essential to underpin any economic decision making. And so that's why this bill is so important. Now, look, I'm under no illusions about the scale of the challenge that I face in this job. There are going to be difficult decisions ahead, but I was really clear during the election that everything that we put forward, whether that is on the NHS or on defence or on tax policy, will always be fully costed and fully funded. That's very different to what we've had these last 14 years, with decisions with no regard to where the money's going to come from. And I'm going to be different.
And Chancellor, I mean, a lot, of course, of what you're trying to put in place will depend on private capital coming into the UK. Have you had discussions with institutions, investors, even pension funds, of their willingness to come to the UK?
You're absolutely right that our plans to grow the economy depend on businesses and investors choosing Britain as a place to invest. And I want investors to look at Britain and see a country that's got a stable government with a clear mandate to grow the economy and chooses Britain as a stable place to invest in an increasingly volatile and uncertain world, which is why the fiscal lock today is so important. But also the other changes we've announced in the last 2 weeks. We have announced more policies to grow the economy than the last government did in 14 years. In the first 72 hours in the job, I made more comprehensive changes to the UK planning system than the previous government did in more than a decade, because I know that we need to unlock that private investment that businesses tell me they are ready to invest if we get rid of some of those blockages. And the blockages in the planning system, I think, are more significant than anything else. And so those changes to bring back mandatory housing targets for local authorities, ending the moratorium on onshore wind, calling in planning decisions on data centres and on housing, really crucial, both to send a signal to business that Britain is a place to invest, but also to make sure that we can get on with things and get building in Britain again.
And are they listening? Have you gotten calls from big investors saying, yes, that's a plan that I wanted to see and I'm in?
Absolutely. So in my first speech at the Treasury a week and a half ago, we had businesses, we had investors in the audience, met afterwards. The following day, we announced the creation of a national wealth fund, work led by Mark Carney, the task force led by Mark Carney for the Labour Party when we were in opposition, now reporting to a Labour government. And on that wealth fund task force, we also had Amanda Blank from Aviva, Venkat from Barclays, Antonio from L&G, and other big UK investors. And that is absolutely crucial, because there's no plans that I can draw up in my new office in the Treasury that are going to work unless we have business buy-in. And I hope that businesses saw in Labour's manifesto and also in the plans that we've announced in government have the fingerprints of business all over them, because these plans have been co-written with business, because they're all about unlocking private sector investment into our economy.
Chancellor, are you considering tax breaks to either boost pension savings or make UK investments more attractive?
I'm not going to announce any tax breaks or tax changes without saying where the money is going to come from. And we will have a budget later this year. But I also just need to be really clear and honest about the scale of the challenge that we've inherited with the public finances. We're going to have to make difficult decisions. We need to fix the foundations before we can start rebuilding things in Britain. But unlike the previous government, I am going to be honest about the scale of the challenge. I'm going to level with people, and together we're going to rebuild our country.
That was the Chancellor Rachel Reeves speaking to Bloomberg's Francine Lacqua. So, big ambitions, but will the support measure up? I've been discussing what's at stake in the Chancellor's upcoming trip to the United States with our UK political editor, Alex Wickham.
It's a big moment for Rachel Reeves. You know, she's got this big gaping hole in the public finances in this country. She has ambitious manifesto plans with Keir Starmer for the Labour Party that they want to implement that are going to cost money. And they see, in the absence of not really wanting to put everyone's taxes up, not really wanting to massively increase borrowing, they see private investment as a key piece of solving that puzzle. So whether she can raise, really tens of billions of pounds over the next year or so to pay for things like the green transition in this country, it is going to be a huge test of the Starmer-Reeves government.
What's the message that she'll be selling to those executives that she'll be meeting on Wall Street?
It's very much similar to the message that was successful with voters in this country at the election earlier this month or last month, which was that, stability is the order of the day now, and they will run the politics and the economics of this country in a way that is predictable and calm and a healthy haven for investors, certainly compared to perhaps other parts of the world where there's more political and economic turmoil. That's obviously a far cry from the last few years in Britain since Brexit, which have been much more tumultuous. So they are going to make the pitch that Britain has changed now and is actually more of a safe haven for investors.
Where does the planned National Wealth Fund come into this? Rachel Reeves wants to raise over £20 billion through it from the private sector. I mean, how achievable would that be?
Well, they're very confident, and governments always say that they want to raise private investment as a way of paying for things that they want to happen. But Reeves is a bit more open about this idea of borrowing to invest as well, and borrowing to stimulate private investment. She has this idea that for every pound that the government invests in infrastructure projects, for example, she thinks she can raise £3 from private investors. Obviously whether she can do that remains to be seen, but for things like green transition, where Labour has been forced to really pare back the amount of state spending that it's willing to put forward for huge projects that are absolutely fundamental to the government's plan to get economic growth, being able to bring in private investment through things like the National Wealth Fund, what Labour people call the multiplier effect of bringing in all this extra private investment, is just absolutely a key thing for them. So they will want to prove early on that there is interest in these sorts of ideas.
This is also a chance for Rachel Reeves to build bridges for the UK outside with its neighbours, and the US, of course, being a very important partner there too. Now, she's focused on the financial side of things, but this is also part of, I suppose, Keir Starmer's government relaunching the UK as a global partner after a tumultuous few years.
Yeah, absolutely. And we haven't heard very much from Keir Starmer on foreign policy for ever, really, until he took office, where really in the first couple of weeks he was at NATO in DC. He then hosted a big summit of European leaders in Britain, and he's really been speed dating sort of world leaders and allies to try to say, I think he used the words "Britain is back" in reference to essentially the Brexit years and under the Conservatives, saying that no, actually under my government we won't be retreating from the world stage. So absolutely, this is a chance for Rachel Reeves to do her version of that on the finance side in the US, and also to really get in with perhaps the next generation of Democrat leaders as well.
Yeah, I mean, at the same time, Rachel Reeves might also be happy to escape some of the problems that she has at home. We had that, conference in recent days, that announcement of the bigger than expected hole in the public finances in the UK too. I mean, the difficult questions about the UK's government finances in the future are also looking pretty tricky.
Absolutely. And, we always talk about honeymoon periods for new governments after they win elections. And certainly the first couple of weeks, everybody in Westminster was being pretty generous to the new Labour government, sort of saying, it's interesting to deal with these new people in charge. Well, Rachel Reeves on Monday gave a speech in which she said she had uncovered that the public finances she's inherited from the Conservatives were far worse than she previously thought. Now, some of that no doubt is true, but there was a bit of political theatre involved in that as well by Rachel Reeves, and it's very much seen as a pitch rolling exercise for for her to raise taxes at the coming budget in October, which, of course, in the general election campaign over only a few weeks ago, she said she wasn't going to do. So that has left a bit of a sour taste in the mouth just 4 weeks into Keir Starmer's premiership. And yeah, absolutely. The honeymoon that new governments often enjoy is very much over already.
Perhaps also Rachel Reeves might be looking for a bit of American stardust too when it comes to economic growth. There'd been a debate during the election campaign here about whether or not a 2.5% growth target might be achievable over the lifetime of the government. Rachel Reeves might be looking very enviously at some of the economic performance in the US as well.
Yeah, and Labour are saying that they want to have the best growth in the G7, and economists are sceptical, to put it mildly, as to whether that will be achievable. The reality is Labour made this big bet on economic growth as the solution to Britain's problems, unlocked by planning reform and house building. They thought that they would be able to grow the economy enough to be able to raise money to fix the public services that are ailing in Britain on healthcare and justice and all the rest of it. Just 3-4 weeks into the job, Rachel Reeves has, if not jettisoned that sort of growth miracle plan, she sort of very much said, OK, well, we're also going to have to put taxes up, which is, arguably inhibitor to growth. And she will face really heavy scrutiny over the next few months over whether she really is still going for growth as the answer, or whether it's actually going to be tax rises on the wealthy that pay for fixing public services, as many people suspected in the election, but she didn't want to admit.
Thanks to Bloomberg's UK political editor, Alex Wickham. I'm Stephen Carroll in London. You can catch us every weekday morning here for Bloomberg Daybreak Europe, beginning at 6 a.m. in London and 1 a.m. on Wall Street. Tom?
Thank you, Stephen. And coming up on Bloomberg Daybreak Weekend, a look ahead to earnings from Chinese tech giant Alibaba. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Continuing the theme on AI from last week, we expect to hear more from tech giant Alibaba's earnings and outlook, and we look ahead to trade data out of China. Let's get to Bloomberg Daybreak Asia co-host Brian Curtis for a preview.
Tom, Alibaba says it will soon launch an AI-powered search engine to help small and medium-sized companies improve their sourcing. Alibaba has been undergoing a turbulent restructuring as it's lost market share to rivals including PDD and ByteDance. The company announced other measures such as charging a 0.6% service fee on both Taobao and Tmall merchants. That could boost revenue. We'll soon learn more about what's happening with the company as Alibaba reports earnings in the coming period. Joining us now is Catherine Lim, Bloomberg Intelligence Senior Analyst for Asia Consumer and Technology. Catherine, thank you very much for joining us. Let's start off with competition. How stiff is the competition for Alibaba now from those firms, like I mentioned, PDD and ByteDance and others?
Right. On the topic of competition for Alibaba, it's coming in multiple directions, depending on which of the 6 key business we're talking about. We've got China, and that's Taobao and Tmall. We've got overseas, and that's AliExpress, against Temu, Shein, even Amazon in countries like US. And then, of course, we have the cloud business, and that's where the AI competition is going on with Baidu and other players from China as well as overseas.
So what do we know about Alibaba's AI-powered search engine? We mentioned there that this is supposed to help small companies with their sourcing. What do we know about it?
So it's currently still ongoing, the trials, and, this shouldn't come as a surprise given that, the training of some of these large language models that's backing it is really the key here. We've seen the initiatives for, AliExpress, who was the sponsor of the Euro 2024, and they've actually trialed some of those for the bigger audience outside of China. And then there was that was going on within China as well. So I would say the company is again trying to get as many scenarios as they can so that, the models is better able to adapt. And I guess, the $1 million question, when will we see results and how it will stack up to competition? I think it's going to take a little bit more time. Hopefully, by the time we get to, the year-end sale and then, the big Singles Day sales, for the company itself, we may be able to see something a lot more tangible and for that to be contributing positively to the company's top line then.
And what will the impact be on revenue of these new fees, 0.6% service fees?
Right. Now, that was really a very interesting development. And I have to actually first, remind everyone that, this technology software service fees have been implemented by PDD, JD.com, in China for, since late last year and in fact earlier, even for Little Red Book, the social media company, and Douyin as well. So Alibaba is the last to implement this. And really, as I speak to the company and understanding where they are coming from, they are really keeping it flexible. They are probably, talking to merchants about what are the ways and how to really implement this 0.6%. There are perks that they are giving back to the merchants though. So net, it may not really be that 0.6%. They are throwing other things like, even, delivery subsidies, etc., if you're able to not meet certain things. So I wouldn't be too, hype up about the benefits to the company from a revenue perspective. It's going to take time. And really what I'm watching out for is whether PDD, JD.com or Douyin, they're going to tweak their 0.6% fee. And it comes in different forms. It's 0.5, up to 1% as far as I understand, over the next few months. Yep.
So a bit unknown. Alibaba's forward PE is just 9. That must be close to the lowest since it went public. We have this restructuring where they're trying desperately to add value. But has the restructuring kind of stalled?
Well, the restructuring, I think they've put it on the shelf for the now. It's still going to be the Alibaba conglomerate that we are seeing right now. No IPOs, no spin-off. You're going to hear more share buybacks for them for sure. And, don't forget that this is a company that have also started paying out dividends, right? So that is the, capital, focus that they have. For their shareholders in the course of the next 12 months. So, until we actually see more signs of improvements to their core business from the e-commerce side to the cloud, I think that is what we can be expecting from the company.
Alibaba has been funding and in some cases acquiring smaller up-and-coming tech companies. We mentioned AI earlier. Well, a company, Baiquan, is a leader in the generative AI space in China. So for those acquisitions, will they be paying dividends anytime soon?
Ooh, most of these startup, as far as I understand, definitely not, making money right now, and they're probably gonna need more of the investments from, the large funders like Alibaba themselves. So I don't think we should be expecting any dividends, and incrementally, if anything, hopefully we see some technological breakthrough, that can actually help and be something new to the market.
All right, Catherine, thanks so much for joining us. We do appreciate it. Catherine Lim, Bloomberg Intelligence Senior Analyst for Asia Consumer and Technology. Next up, let's get to our co-host, Doug Krisner, for a preview of China's trade data.
Brian, we know that China's economy is struggling. Poor sentiment is keeping households and businesses from spending and investing, and as a result, domestic demand remains sluggish. If there's a bright spot, it's the strength of exports. For 2 straight months, the increases have topped forecast. Now, manufacturing and exports remain crucial pillars of China's economic recovery. However, weakness in parts of the global economy are creating some headwinds. Now, the latest official manufacturing PMI showed contraction for a 3rd straight month, and factory gate prices seem to be trapped in deflation. Joining us now for further discussion of China's economic recovery is Katya Dmitrieva, Bloomberg Asia economics correspondent. She joins us from Hong Kong. Nice of you to drop by. Let's begin with the trade data. And
what this may tell us about how well China's economy is doing right now?
Well, the trade data will tell us a lot because it's been the growth engine of the economy so far this year in really surprising ways, I think unexpected ways for economists. We were looking for a bit more of the consumption to play a role, and that just simply hasn't happened basically since January. So the trade data will tell us where the economy is going, more so than if you're looking at the U.S. or a European economy. There's a lot of different pieces that fit together to tell the story. But I think for China right now, it is so dependent on exports and on manufacturing and industrial production. So this in particular will be July figures. So we're already halfway through the year. The story so far this year for China has been strong manufacturing, strong trade, and then a little bit of weakness on prices for those exports. The question is, what will be the story for the second half? And some of the data that we've had recently points to this potentially not being as good of a story.
One of the issues that we've heard about as it relates to the industrial economy in China is this issue of overcapacity. Is that part of what we're seeing right now?
Overcapacity is an interesting term, and I think you'll hear different answers from different people about what that means. But I think generally when we talk about overcapacity, it's this idea that China is just producing too much stuff. And certainly it's producing too much for the domestic market and consumers to eat up. And so we're seeing that going into exports. And as a result, there's so much competition and price competition that those prices of exports are dropping. And so, in the short term, that might be a good thing. In the short term, you're really juicing all of your goods out of the country. It's contributing to manufacturing growth, to jobs, to employment, to wages. But in the longer term, as you get that price erosion, that's actually not good for Chinese companies. The other thing we have to remember about China, and it seems silly to say, but it is a very big country, and there's competition among domestic markets as well. So when a U.S. or Europe kind of looks at China and says, well, there's clearly dumping or there's clearly this overcapacity issue, domestically, it's not orchestrated, right? Like you have domestic producers in various provinces competing to be the best province or the best region within China. And so that's where you get a lot of that price erosion happening because, hey, I'm in this province, I'm offering you a price that's going to be lower than this other province. But, the overall, that's obviously not good for trade tensions globally. We've seen government officials addressing that in the plenum and some of the other annual meetings this year. But like with other measures announced so far, it just needs a lot more detail.
So a moment ago, I mentioned that domestic demand is very weak right now, and I'm imagining this is going to translate into lackluster imports, will it not?
Yes, and they have been pretty weak. If you look at even last month in June, June's trade data, you would see that exports were over 8% growth, but imports were in the negative. And so that's also something that has been heard from Western countries is they want to see consumers in China come back because that's good for their own companies. So it's not just about competition in domestic markets with EVs or other green tech. It's also about their own, economy's growth.
So the next question that I have, given everything that we've kind of sketched out there, the role of the government in trying to stimulate both sides of what we're describing, the import side, that would be the domestic demand story, and the export side where we're talking about a reduction in some of the capacity. Is that likely? Will Beijing step in a meaningful way?
That's what we've heard from officials. We have heard through the plenum, if you look through the document and, the 20,000 word document that was put out, there are a lot of promises of reform, and particularly reform in the industrial sector and in manufacturing. Does that mean sort of big fiscal stimulus and injecting money into domestic industries as we saw other countries do during economic crises? Probably not. They really want to encourage local industries to be self-sufficient, especially, after they helped pop the real estate bubble, there's really a sense in the country that they want companies to stand up on their own.
Katya, thank you so much for helping us preview this week's trade data for China. Katya Dmitrieva, Bloomberg Asia economics correspondent, joining us from Hong Kong. I'm Doug Krisner. You can join Brian Curtis and myself weekdays here for Bloomberg Daybreak Asia, beginning at 8 a.m. in Hong Kong, 8 p.m. on Wall Street. Tom?
Thank you, Doug, and thank you, Brian. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.